Imagine this. You have a huge, global company, a brand you see every day. They seem to be swimming in cash, right? And they've got the paperwork to prove it. A bank statement confirming they hold almost 4 billion euros in one single account. That's a fortress of capital that would calm any nervous investor. But what if that bank statement, the one single document proving they're stable, was just a cheap forgery made with a scanner? And what if the account, the money, the whole thing, was a complete fiction? Well, this isn't a movie script. This is the real story of Europe's biggest and maybe most audacious corporate fraud.
Right, let's get into the incredible story of Parmalat. On the surface, this company was the ultimate Italian dream, a family-run dairy giant that brought long-life milk to pretty much the entire world. It was a wholesome, trusted brand name. But underneath that squeaky clean image, it was hiding a multi-billion euro secret, a financial black hole so huge it would end up swallowing the entire company and shaking the very foundations of European finance. So to really get a sense of just how big this implosion was, you've got to understand how massive Parmalat had become. By 2002, we are not just talking about a big Italian company. No, we're talking about a global food powerhouse. This was Italy's 8th largest industrial empire. We're talking over 36,000 employees in 50 different countries. Their milk, their yogurt, their juice, it was in refrigerators everywhere, from Rome to Rio. It was a true symbol of Italian industrial might. And at the absolute center of this empire was one man, Callisto Tanzi. You know, in Italy, he was this larger-than-life, legendary figure, a university dropout who took over his dad's small food business and just through pure ambition built this global behemoth. He really cultivated this image of being a pious, fatherly leader, the beloved patriarch of this huge corporate family. He sponsored sports teams, he donated to charities, and he was super connected to Italy's political and financial elite. This timeline here really just captures their insane meteoric rise. The absolute game changer, though, came in 1966. See, Tanzi jumped on this new Swedish technology from a company called Tetra Pak to create UHT, or long-life milk. Suddenly, milk had a shelf life of over 6 months without refrigeration. I mean, this single innovation was revolutionary. It's what allowed Parmalat to just explode out of Italy and go global. After they went public in 1990, they used all that cash to go on a wild shopping spree, buying up companies all over the world. But as the company got bigger and more complex, this really strange paradox started showing up on its balance sheet. If you actually looked at their financial statements, you saw two things that just didn't add up. On one hand, you had a gigantic pile of cash, billions of euros supposedly just sitting in the bank. And on the other hand, they had this relentless, almost desperate need to borrow more and more money by issuing bonds. It's like having $1 million in your savings account, but still taking out a high-interest loan to buy groceries. It makes absolutely no financial sense.
And that was the billion-dollar question that savvy analysts and investors started whispering about. I mean, it's fundamentally bad business. You're creating what's called a negative spread. You're paying high interest, let's say 6 or 7% on all the debt you're taking on, while the billions in cash you supposedly have are earning next to nothing sitting in a bank account. You're just burning money for no reason. It was a massive red flag. Now, here's where it gets really interesting, because those quiet whispers started to get a lot louder. In late 2002, the investment bank Merrill Lynch published this scathing report called, and you can't make this stuff up, The Straws That Break the Camel's Back. They downgraded the stock from buy to sell and just put the whole mystery in black and white for the entire market to see. They were basically shouting from the rooftops that something was deeply, deeply wrong with Parmalat's financial strategy. So how did Parmalat's leadership respond to these very public, very pointed questions? With total arrogance. The chief financial officer, a guy named Fausto Tana, was notorious for this. Any analysts who dared to question the company's bizarre financials on conference calls were met with insults and just plain hostility. The company operated like a black box, refusing to explain its strategy and essentially telling the entire financial world, hey, trust us, we know what we're doing, now stop asking questions. And then, in late 2003, the cracks just shattered the facade. On December 8th, the unthinkable happened. Parmalat, the company supposedly sitting on billions in cash, defaulted on a 150 million euro bond payment. The market was absolutely floored. The share price went into a complete freefall, panic set in, and the company desperately needed to prove that its finances were real. And all of their proof, their one silver bullet to solve this whole mess, rested on a little-known subsidiary way out in the Cayman Islands called Banlat Financing Corporation.
Officially, Banlat was the group's treasury center. But as investigators would later find out, Banlat was actually a corporate garbage can, an offshore shell company designed for one single purpose: to hide all of the group's mounting losses and store its completely fabricated assets. This was the magic number. The entire credibility of the Parmalat empire now came down to this single figure: 3.95 billion euros. This was the fortress of cash that Banlat supposedly held in an account at Bank of America in New York. If that money was real, then hey, the company was solvent, and this was all just a big misunderstanding. If it wasn't, then the whole thing was a lie. On December 19th, 2003, the truth came out in the most brutal way you can imagine. Parmalat's auditors, finally forced to do their job, contacted Bank of America directly. And the response, well, it brought the entire house of cards crashing down. In a cold, clear statement, Bank of America confirmed it. The confirmation document was a forgery. The account number was fake. There was no account. The nearly 4 billion euros was pure fiction. It had never, ever existed. But believe it or not, the story gets so much worse. This wasn't just a case of a missing 4 billion euros. Once investigators really pried open the books, they found something that staggered even the most seasoned financial experts. The company wasn't just short on cash. It was hiding a mind-boggling 14 times billion euro black hole. It instantly became Europe's biggest bankruptcy, a financial crater that shook the entire continent. And you know, for fraud of this colossal size, the way they did it was shockingly simple. It was a basic 3-step process they just repeated for over a decade. First, you hide the real losses from your failing businesses by just transferring them to offshore shell companies like Banlat. Second, you create fake assets and revenues out of thin air using forged invoices and phantom trades. And third, while all that's going on, you siphon off real company cash to prop up Tanzi's other private family businesses, like a travel agency and even a professional football club. And this one little detail just drives home how brazen this whole scheme really was. That crucial Bank of America document, the one proving the 4 billion euros, investigators found it was a crude forgery literally pieced together by finance officers using a basic office scanner. When the CFO was later asked in court why they picked Bank of America for the fake account, he just shrugged and said it was simply the first to come into their head. I mean, unbelievable. So, in the aftermath, the legal system finally kicked into gear, but the results were, let's say, mixed. Callister Tanzi was sentenced to 18 years, but because of his age and health, he served very little time in an actual prison cell before being moved to house arrest. His CFO, Fausto Tana, was also sentenced, but the blame spread much wider than that, swallowing up the auditors and the huge international banks who had collected hundreds of millions in fees from Parmalat for years, while apparently looking the other way. You know, this whole saga is a textbook case of something called the gatekeeper problem. The entire financial system is built on a foundation of trust. Trust in these so-called gatekeepers, the auditors, the investment banks, the ratings agencies. They are supposed to be the independent watchdogs protecting investors. Parmalat is the ultimate example of what happens when those gatekeepers either fall asleep at the wheel or, even worse, become complicit in the very fraud they are paid to prevent. The fallout from all this was immense, and it forced some real change. Italy had to completely overhaul its financial and bankruptcy laws. The European Union was basically spurred to create tougher auditing standards all across the continent, trying to prevent another Enron or another Parmalat. And the company itself, well, unlike Enron, it didn't completely vanish. It was put into administration, brutally restructured, and eventually re-emerged as a much smaller, humbled company that actually still exists today. And that really leaves us with a final, pretty provocative thought. The Parmalat story shows a complete system failure. You had executives who lied, auditors who failed to check, and banks that enabled the whole thing. So it forces us to ask, in a global financial system that is ultimately built on trust, when all the professional watchdogs we pay to protect us fail, who is left to watch the watchers?